Volatility reawakening in 2018 and beyond, and it's more of the same really that a lot of us know is happening at the moment. But what's key is the investor mindset is changing finally. We had the flash crash of February this year where we had a 1,300 point drop in the Dow Jones. Most people thought that was it for the year, but it wasn't. Back then it was a margin call on volatility, so all of those volatility products that basically disappeared overnight. And most recently, it was anything that was top of the pops. So if we think about momentum plays like FANG and the such have basically capitulated. And that's what we're seeing now throughout the year and likely into the new year. Well, I mean, interestingly, the phrase is usually when the US sneezes, the rest of the world catches cold. It was the other way around this year, and during a trip to Asia, that's one of the things I experienced in speaking to clients, that the BAT stocks, the equivalent of FANG, had cliff dropped, and so it was likely to create some kind of psychological contagion in the market back to US tech. So that has played out correctly. And now what we're seeing actually is the S&P 500 just coming back to the old crash low, or let's say mini setback low, where the market's at this wait and see mode. If you're looking at the tech sector in China or in Hong Kong, it's actually broken to new lows and it's still in a downtrend. So if you believe that correlation will hold like I still do, then there's further downside on the S&P 500 and tech in general. Let's keep in mind, of course, the FANG stocks when we're looking at Facebook, new year-to-date lows, and Apple, the biggest drop in 10 years. Well, on the S&P 500, we've broken below a 3 sigma deviation. All that means is the 2-year trend that it's been in since 2016 being the low has stretched quite a lot. A lot of trend followers would have got this one wrong. The trend is your friend until we get reversals like this happening. And so we're below the 200-day moving average, so a lot of trend followers would have got caught out on that, looked to buy on the dip. We didn't get a follow-through on the dip. So now we're looking like a new low breakout into the 2,500 to I think it's 2,500, 2,550 level. That's a price vacuum area. And if you look at the chart on the screen, I've got a probability distribution tool that just basically measures the ticks, the price ticks, and it just shows you where key levels exist, but also where there's a potential gap in the market, and that's where we're likely to go now, a further downside into around 2,500 on the S&P 500. And this is really where the investor-trader psychology comes in. We've been comfortable for too long. Remember, last year, vol was so low historically in many years. And so we're getting a mean reversion from very comfortable markets, low vol, VIX at all-time lows, to a change. Now, fundamentally, of course, there's a shift going on in the background. We're having more of a tightening cycle in terms of credit. The Fed's obviously leading that. US rates have been rising, looking like they're spiking actually, and then that might continue, in my opinion, from a technical perspective. So that's creating a little bit of issue in the markets. But also, look at Bitcoin as a case in point. It's broken below that 6,000 level. It's heading into the target which I cited it for 3,000. That's not correlated, and yet it is, if you think about psychology in the market and just general volatility across the board. Well, as a mentor once taught me, try not to catch a falling knife, but if you really need to, wait for it to hit the ground and shake from side to side. So look for that potential bottom in place if you're looking to buy on the dip, or if you're just looking for a general recovery process. But make sure that there is sign of a recovery from oversold conditions. At this stage, I think it's too soon, too dangerous, and it's probably best to either trade it, probably on the short side, but with tight stops, and just be very aware of change.